What's up, everyone? It's Scotty with MoneyVest. So today we've got lots to unpack because the markets did rebound a little bit here on the day, but we do have to discuss the Buffett indicator. We've got, again, interest rate expectations and also investor survey from a lot of Wall Street banks and institutions expecting for a potential US recession at some point in the next 12 to 24 months. So as always, if you enjoyed this video, find it helpful, all I'm asking in return is that you drop a like and of course subscribe to the channel if you haven't already. And the links to our Discord and Patreon is going to be down below. Again, 4 more days left if you want to take advantage of that 16% annual discount until the end of this month. I've opened up a few more spots if you're interested in joining, getting access to all the members only private videos, including all the TradingView charts and watch list, and as well as the TradingView alerts here, trade alerts, ideas, options alerts. Everything's going to be included, as well as the potential to beta test our moneyvest.com website that's going to be launching fairly soon. So link's going to be down below. We'll love to have you on board. So first things first, let's talk a little bit about the market here. So we did have the NASDAQ, rallying a little bit over 51, 56 basis points. So not a bad day for the markets here. S&P 500 pushing up about 86 basis points, and the Dow Jones pushing up to almost 40,000 here, pushing up over 1.2%. We did see a lot of consolidation for most of the day, and then a little bit of a spike towards the end of the day to close out fairly strong here for the markets. Now, nearly half of all investors expect a no landing scenario for the economy where inflation remains, but there is no recession. Deutsche Bank surveys basically shows, and this right here is the survey findings, and you can see the progression of how that's happened since December of 2021. So what this chart basically shows us is the dark blue is we are already in recession. The not so dark blue is that we are going to get into a recession later in 2023. The light blue is 2024, and then the gray is 2025. The lighter gray is 2026 or after, and then of course the red is going to be don't know. So as you'll notice that towards the end of the year, so of course all the way till October of 2023, we basically saw that later in 2023 that those expectations basically came down, rightly so, because we were towards the end of 2023. But as you'll notice that January of 2022 and September of 2022, when those surveys took place from Deutsche Bank, over 70 to 80% of market participants believed that we are going to be in a recession later in 2023. So they were expecting for a recession later that year. So this was back in June and September, but those expectations continued to come down as we never really saw a recession, even though we did see, let's say, 2 consecutive quarters of economic growth kind of declining. Earnings also did decline 2 consecutive quarters in a row. But even though on technical terms that should be considered as both an earnings and an economic recession, the actual authorities, which I forgot what it was, they did not really announce for an official recession, and they don't usually do that few months after, and for that, for that progress to continue. In other words, for that earnings expectations to continue to go down, economic conditions to also worsen, they don't announce for a recession unless it is a worsening situation. So bottom line is expectations for recessions were very high for us to see one at the end of 2023, but they continue to come down. Now, what you'll notice is that in June of 23, so towards the same time last year, less than 12 months ago, the expectations for 2024 were really, really high, right? So 2024, again, we were really high, 59%, 71%, and that has once again continued to come down to practically really, really low levels. So very few people, only 13% of market participants are now expecting for a recession this year in 2024, and now majority of them have pushed their expectations forward to 37%, now expecting in 2025. So the bottom line is, at the end of the day, nobody really knows what the heck is going on or when the recession will happen, or are we even going to see a recession or not. So really what you'll notice is that 19%, right? 1/4, or actually 1/5 of the participants now are clearly accepting the idea that we don't know. And see, that's the thing. Like, I have been super honest about all of this on my channel for such a long time. Like, I have no problem telling you, like, I don't know. Like, I don't have all the answers. And I think that's really what's most important is this right here, in my opinion, should be 100% I don't know. Because at the end of the day, nobody really knows when the recession is going to take place. I think the most important thing to really do and to really prepare for is expect a recession always, right? Expect a recession, expect a bear market, and then really position yourself in such a way that you're not over leveraged, you're not risking too much capital to generate a return that might be that might force you to take on additional amounts of risk. So it's really just having that approach of being cautious, being alert, and at the same time being prepared for all potential scenarios and outcomes. So, but anyway, wanted to go over that, and let me know your thoughts down in the comment section below. And as you'll notice that in 2022, we did see expectations come down for a recession in 2023. In 2023, we saw expectations for 2024 recession come down, and now in 2024, we're seeing expectations for 2025, which in my opinion will continue to come down. Now, the only way this is going to flip the script here, because even a broken clock is right twice a day, and that simply means that if you keep on predicting a recession, eventually you will be right. And I don't want to get into that sort of game where I'm trying to predict a recession and then I keep doing it every year and then eventually I'm right. So the bottom line is expect it. Know that it's going to happen in the future. It's just how the market cycles and economic cycles work. We go through a period of lots of expansion and lots of growth, and then we go through a period of contraction and some type of recession or a bear market, and then we recover once again. That's just the cycle of the market that we have to just understand and be accepting of. Now, moving over, just a year ago, most investment banks and Wall Street investors were forecasting a U.S. recession due to the impact of persistent inflation and higher interest rates. Some 65% of economists polled by Bloomberg in March of 23 were convinced that the U.S. economy was headed for a serious downturn within 12 months. But with the U.S. consumers and businesses proving their resilience over the past year, Wall Street's top minds have mostly abandoned their recession predictions. Even what was long considered to be the obvious alternative to a recession, a soft landing in which inflation fades but economic growth is weak, is increasingly in doubt. Again, bottom line is nobody has any freaking idea on what is going to happen. Okay, our job is to better understand market statistics. And that is exactly what we are going to be building in our platform. There's going to be a macros dashboard, and that macros dashboard is going to not make any predictions, but it's going to essentially tell you what's already happened. It's going to give you actual concrete data-driven statistics, and we're going to tell you in the last 100 years, S&P 500, how many times has it been down over 20% from its all-time highs? What percentage of times it's been lower than 20% from its all-time highs or more? And those types of sort of metrics are going to be super important. It's also going to go over and share analysis like how long did it stay there? What's the average number of days or weeks or months the S&P 500 has spent down over 20% from their all-time highs? How long did that recovery take? And what was that consequent recovery after being in a bear market? And again, a lot of recession indicators as well, because at the end of the day, really, I mean, we have to understand that if there is a growth in overall, population, if there's growth in economic growth here, and we are continuing to see technology drive higher earnings, higher efficiency, higher productivity, then there is going to be that aggregate increase in the market value of all these companies as well, the market caps and how big they actually become. And overall, that's going to grow the stock market over longer periods. So that's why the best strategy, one of the best ways to invest has been to consistently dollar cost average in broad-based ETFs and index funds and not really worry about trying to time the market. Of course, there's better opportunities in individual stocks, but that of course also requires a more active participation in understanding the fundamentals of each company, understanding the moat, understanding the industry that it belongs to, understanding the potential in the future, and of course forecasting for the actual fundamentals of how predictably and how consistently can the company grow its revenues and profits and free cash flows. So that is for a separate video, but just get an idea here that, predicting a lot of these things is almost impossible for anyone to do. And our job as investors, as traders, is to really assess the risk and reward in the present as of today and make decisions based off of that to better understand whether it's worth buying, selling, or holding in this type of market. Now, speaking of market cap on an aggregate basis, Warren Buffett's indicator hits a 2-year high, signals stocks may crash. Again, lots of FUD, lots of fear, uncertainty, and doubt, kind of, singling out one single indicator, Warren Buffett's name, using that for the media to kind of create a lot of clicks and a lot of fear. The Buffett indicator takes the combined market capitalization of all actively traded U.S. stocks and divides that figure by the latest quarterly estimate for gross domestic products, or GDP. So it's the market cap divided by GDP. And the Wilshire 5000 index has jumped 9% to a record high this year, boosting its market cap at over $51 trillion according to the Wilshire indexes, and the US GDP is up about 40% from its pandemic lows to $27.94 trillion. If you basically divide those two numbers, we are looking at the Buffett indicator to be about 186%, still lower than where it was during the bear market of 2022. So again, not saying that this is going to create another bear market from back in 2022, but yes, we have to be cautious. We have to be somewhat aware of where we are with respect to the market cap versus the GDP. And every time we kind of go up, we set a new norm, right? We set a new normal. I mean, what considered as the peak back in 1990s is now not even a support. It's actually much higher than that, right? So what's happened in the past doesn't mean it is going to happen again. Of course, lots of people say that this time it is different. But this is the overall pattern. This is the overall trend of how this chart has been moving, and that has just been pushing higher, and a percentage of the market cap over GDP that's continue to set a new norm for this index as we have progressed over the years. Now, again, this could, if I were to really push a super bearish, super FUD narrative, I could easily say that this is a big bubble brewing underneath, and this could eventually lead to a big crash, all the way down to where we were back in the 2007, 2008 in the 50 to 60% level, because I believe that's a much better level to be. But like I said, nobody really knows, what is going to take place. I mean, everyone here, everybody on YouTube that you see, everybody on media, everybody on CNBC, everybody that you listen to or watch is doing the same thing, right? We're trying to dissect the data, we're trying to synthesize the data, aggregate it, and better understand what is most likely to happen. But at the end of the day, we have to understand that nobody really knows. Nobody has any idea on what is going to happen. Federal Reserve interest rate outlook, 5 cuts in 2025 as U.S. economy slows, S&P 500 economists. So the Fed could cut rates 5 times in 2025 according to S&P Global Ratings. A slowing U.S. economy will give the Fed the green light to cut, the firm predicted. Again, that implies the Federal Reserve will lower rates by 2 full percentage points as inflation continues to cool. So solar stocks also edging higher. So we did actually see a significant momentum for a lot of solar companies. So we did have, Enphase pushing up over 9%. So I do have my solar watch list. If you come down over here, First Solar pushing up over 9%, Solar Edge up over 9.8, almost 10%, Enphase up 9.5%, and Sunrun up over 16%. So I'll actually be doing a separate, more dedicated video on these companies to go over their entire momentum, and of course what happened on the day, and kind of like an updated analysis on Enphase as well. But again, a very, very strong move to the upside for solar stocks. Now, I did actually do a video on going over the whales indicator, the L3 banker fund flow trend oscillator, which was in one of my other videos, and I think it's a very, very helpful indicator for us, because if you take a look at Enphase, what's really happening here is that we are starting to see some blue bars. And if you come over to the explanation, the blue candles are essentially the banker fund weak rebound with blue candles. So, there's a possibility that we are seeing some weak inflows come into Enphase. The green ones are really what is going to drive a lot of momentum. And both times we've kind of traded back up to that double top resistance at 138 has been the level to watch for Enphase, of course, and that's where the green bars have come in, and the green bars are essentially the candles that our bankers are increasing their position, right? That's the whales indicator, that's the banker, oscillator that's telling us that, okay, there's big money now entering the stock or entering the market, and that's how we're seeing those green candles pop in. Right now, you could argue that this is, those move on the day, 9.5%, whatever, is happening on the week, on the back of very weak data from the banker and the whales here. But of course, we're potentially getting back up to 137, 138. That's going to be that next target for Enphase, and I actually did share a trade idea on Enphase last week as well. So again, if you want to access all the trade ideas and the alerts and the options alerts, link's going to be down below. We'd love to have you on board. But this right here is a nice rebound from its support of close to $100 per share. So this is basically some of the other key signals to watch for. I mean, we've got yellow candles, green candles, white candles, red candles, and blue candles. And blue candles are essentially a weak rebound. Red candles are the worst ones because that means exiting or quitting that position. White candles are decreasing that position. Green candles are increasing that position. And yellow candles are the entries for the banker funds flow for the trend oscillator as well. So what we have really seen is some white candles, which again are going to be decreasing that position. So we see that increase with the green, decrease with the white, and then red is going to be the exiting or the liquidating of that position, and blue is going to be somewhat weak rebound basically for that stock. Now coming over to the market, so we did have again a fairly green day with NVIDIA selling off on the day, but Amazon, Apple with a nice rebound. Apple, we had a trade idea still on board right now because it's still performing well. Industrial, real estate, utilities, all these sectors pushing up very, very nicely. So the entire market was very green, so very broad-based rally here on the day, except for NVIDIA, of course, struggling a little bit. In the last 1 week, of course, most sectors and most stocks are green, except for technology. And in the last 1 month, again, all sectors are green. Cocoa prices, Russell 2000, coffee prices, everything pushing higher with volatility. Lumber prices, cotton and natural gas, selling off Bitcoin just under 69,000 and Ether just over 3,500 as well. Volatility continues to get crushed here, trading back under 13, so a little bit over 3.5% down. Resistance at 15.3. We've got a huge, again, area of caution inside this red rectangle to watch between 11 and 12. And of course, crude oil here also trading right above that support here, trading almost at that resistance at $80-$81 a barrel. Something to keep in mind for crude oil as well. Bitcoin once again getting rejected at that resistance at almost $70,000. So that is going to be that level to keep in mind for Bitcoin, and Ether here just over 3,500, getting a little bit of that resistance here at roughly around 3,550, and decent support level in the near term is going to be sitting roughly at around here at 3,000, all the way down to inside this green rectangle between 2,200 and 2,400 for Ether as well. So coming over to the market, S&P 500 here rebounding very, very nicely. So we did see 4 consecutive days of red candles, and of course the buyers stepping back in and pushing right back up. Support level is going to stay put at 51.85 to as much as 5,200, all the way down to as low as 5,060 for the S&P 500 as well. So those are there a couple levels that we've been watching, almost at new all-time highs once again for the S&P 500. Talking a little bit about the NASDAQ, so IXIC, lots of cash sitting on the sidelines. That's exactly why we're seeing so much momentum for the markets. Every dip, every pullback, every smallest of red candle or red days here gets bought up fairly quickly because of the amount of cash sitting on the sideline. So again, lots of consolidation sideways in that red rectangle. We are still validating that higher low very, very nicely, and support level very strong, sitting roughly at 14,300, kind of aligned with that 200 simple moving average as well. Apple, on the other hand, with a very nice potential rebound, 2% green. RSI MACD also pushing higher. So you can actually see the yellow candle, right? That's quite interesting because that does suggest there was entry from bankers or whales. Because if you come back to the L3 banker fund flow trend oscillator, the yellow candle basically does suggest banker fund entry with a yellow candle, and lots of momentum. Volume on the day for Apple was around almost 60 million, so a little bit shy of the average 30-day volume, but we did see some yellow candles. Actually, in the last 3 days, we've seen yellow candles come in, so there's been some entries from whales sitting at that support, recognizing that area of support inside the green rectangle and stepping in for Apple. 197, 198 still is going to be that resistance. For Amazon, there hasn't been a lot of activity, although we have seen some blue bars basically suggesting that this has been a recovery or a rebound on some weaker flows. Resistance is going to stay put roughly around this $179, $180, and that kind of makes sense because the volume's been fairly low. Support level is going to stay put 159, 160. I feel like that's going to be a very, very strong level to keep in mind for Amazon. Also aligned with that higher low, the 21 EMA and the horizontal support. All of them kind of have this confluence at those prices for Amazon. Tesla, on the other hand, is starting to see some momentum back higher. So you can see that we did see some entries for bankers, and actually the last time we actually saw that, Tesla did recover and rally a little bit. So we did see, a 16% move back higher to almost $200 per share as bankers were kind of increasing their position. There was more flows coming in, and right now we're kind of witnessing a very similar thing where we did see a banker kind of entry at around those levels from March 20th, and we're starting to see some green candles pop in with that bullish divergence on the RSI, and the price action does suggest that maybe there is potential for us to retest back up to $200, $205 per share. That's going to be inside this red rectangle, so keep a close eye on that. NVIDIA, that's actually going to be quite an interesting one. What do you think? What do you think are we going to see in the L3 Banker Fund oscillator here? I feel like we're going to potentially start seeing either white candles or we're going to see some red candles. White candles, remember, are going to be the decrease in positions, and red candles are going to be exiting and quitting on that position. So let's just take a look on what that looks like. Ooh, we actually don't have a lot of white or red. We did have a little bit. So we did have a weakening rebounds over here. We did have some exits, but really just, the last couple of days, I mean, it could be retail that's basically selling at this point, I feel like, because this indicator is still suggesting for some funds still stepping in. There's still increases in position from a banker fund oscillator standpoint, but the RSI is looking pretty bearish. We got the MACD also stepping lower, and of course we've got a huge support for NVIDIA sitting roughly at around 844, 845. But the last couple of days, I mean, we've seen a pretty nice, decent 2.5% drop for NVIDIA. So keep a close eye at roughly around $839, $840 for this company. Quite interesting that bankers are still buying here. Advanced micro devices, we have seen pretty significant amount of exiting or quitting for advanced micro devices from highs of 226. It's been selling off RSI, MACD, as well as this L3 indicator. All of them looks pretty bearish. Support level is going to stay at roughly at 164 down to as low as 150. And of course, a much stronger support here at this 200 simple moving average at 130, 131 for advanced micro devices. Talking about PayPal, and PayPal on the day here getting rejected. Not a surprise. Can't blame a guy for trying. I did a video on this yesterday talking about how PayPal is coming to approach to its huge resistance. If it does break out, the next target is going to be $77 and will finally be breaking out from a lower high, lower low pattern, and will be making actual higher highs for PayPal. There's been a lot of involvement from institutions. Whales have indeed been buying and kind of adding more to their positions on PayPal. But right now, of course, we're back to testing that resistance. Once again, a breakout above this can really change the overall direction for PayPal. Of course, only time will tell if that is indeed going to happen or not. Visa has been selling off, so you can see that we have actually started to see some whales and bankers kind of exit Visa as a position as it has continued to pull back after being very overbought for a very long time, and of course trading at all-time highs. Support level is going to stay up at a 273 for Visa, and below that we're going to be watching that 21 exponential moving average for this company as well. Meta platforms, we're starting to see some weakening rebound as well as some exits here from some whales. Institutions, support level is going to stay up at 475 down to as low as 450s inside this green rectangle for Meta that we need to watch very closely, all the way down to as low as 386 for Meta platforms as well. Talking about Netflix, and Netflix here also starting to sell off, down about 2.5%, so a little bit of a red candle here. RSI, MACD also showing signs of some more potential downside, and much stronger support. It's going to be sitting roughly at 536 down to as low as $472, kind of aligned with that 200 simple moving average as well. Google, on the other hand, very nice rebound. You can see the bankers did kind of entry very, very nicely on that day. I mean, Google had a very nice recovery from that trade idea that we mentioned and a lot of increase in that position. RSI, MACD, kind of everything kind of lined up really well for Google, and of course we did see a 15 to 16% rally back up, 155, 151. We kind of approached that level, and right now we're just sitting right under 152 at the moment. Microsoft, on the other hand, did see a bit of a pullback. It's just really been consolidating sideways. White candles, meaning that they are starting to decrease their position on Microsoft. So that is something to keep in mind. RSI is also consolidating sideways with the MACD almost on the verge of crossing below the signal line, which could result in some potential pullbacks and support levels inside this green circle aligned with the higher low, the 21 EMA, and the horizontal support at $395 to $400 per share. Enphase we already went over. Finally, we're going to come over to Costco, and Costco here really consolidating sideways. There's been some exiting and selling pressure from the whales, from the bankers here. RSI pulling back. MACD did cross below the signal line. Support level is going to stay put at $711 down to as low as $645 to as low as $600 for Costco. So hope you all enjoyed this video and a complete update on the markets. Let me know your thoughts down in the comment section below. Again, the bottom line is I think it's quite useless to make predictions, and what really we need to do is kind of assess the risk and reward in the present day, better understand how the markets are positioned, what's the valuation, how are the technicals looking like, and then come to a judgment, come to a decision after doing proper due diligence, whether it's time or whether it's appropriate to buy, sell, hold, buy or sell calls and options like puts. What's the best strategy to approach the markets with based on the information given to us today. Not trying to predict what's going to happen, because chances are predictions are never accurate and they are most often wrong. You can't get it right consistently anyways. So hope you all enjoyed this video, found it helpful. Make sure you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, there is a 16% annual discount available until the end of this month. As always, happy investing. I'll see you all in the next video.